Hello and welcome to the weighted average cost of capital. And so what I'm going to do in this video is I'm going to explain what the weighted average cost of capital is. And really it's what the whole of corporate finance is about. So it's a very important subject. I'm going to explain how it's calculated. And then we're going to go through the traditional, the theories of weighted average cost of capital, the traditional theory, Modigliani, Miller, and then real world. And we're going to see how corporate finance works. So for those of you who want to get into the corporate finance industry, or those of you who are studying this in economics or accountancy, this is the video for you. So what is the weighted average cost of capital? So it's the average return to all sources of capital used by an organisation. So let's just have a world where we've got some shareholders providing £1 million worth of equity, and those shareholders require a 10% return. And we got £1 million worth of debt, and those bankers require a 5% return. So we got £2 million worth of capital, and they require a £150,000 return. So the weighted average cost of capital is the return divided by the capital. So we got 150,000 return divided by 2 million of capital. The weighted average cost of capital is 7.5%. That's what it is. Why is it important? Well, the value of a firm or an organisation is the net present value of all of its future cash flows. So the value of it, so we take all of our cash flows, we discount them by the discount factor, and that creates the net present value, and that is the theoretical value of any firm. The weighted average cost of capital is the risk associated with each capital stream and the capital provider's time value of money, and that is the discount factor that is used in this net present value calculation. So the discount factor that we use in the net present value calculation is the weighted average cost of capital. So if we think about that, we've got two ways that we can increase value. The first one is that we have the same weighted average cost of capital, but we improve the position so we got more cash. So we've got more cash flow. So let's take a perpetuity, so £100,000 forever and a day each year, and we got a 10% WACC, so a 10% discount factor. The value of that company then is 1 million. 100,000 divided by 10%. If we increase those cash flows, that perpetuity by 10,000, so we've got £110,000, we maintain the same WACC, the value of that perpetuity has gone up to 1.1 million, the value of that firm's gone up to 1.1 million. So if you want to see how to calculate perpetuity, look at another video. In terms of that seems a bit hard. We've actually got to do some operations and improve that. It's a bit risky as well. What we could do though is we could keep with the same operations, the same cash flows. Nothing changes on the business sort of side. But what we do is we change the capital structure and we somehow reduce the weighted average cost of capital from 10% to 8%. What happens then? Well, our business value goes from 1 million. So suddenly, 100,000 every year being discounted now by an 8% discount factor, our value has gone up to 1.25 million. So we haven't changed our operations at all. We've not changed, which is quite a difficult thing to do. But we've increased our value by reducing our weighted average cost of capital. And this is actually quite a nice certain thing as well. It's quite sort of straightforward to reduce the weighted average cost of capital if you can do it. So the risk of the company, if we do it in the operations sort of side, is that actually this might be more risky what we've done to increase these cash flows. So actually all that happens really is the weighted average cost of capital goes up. So we've got two methods really of increasing value: increasing the cash flows to the same WACC, reducing the WACC for the same cash flows, and reducing the WACC for the same cash flows is the easier method. So is this possible? Can we have these changes of weighted average cost of capital? Well, the traditional theory of the weighted average cost of capital says yes. It says that there's providers of equity. They typically require a high level return on their equity, regardless of the initial risk. So let's say they're requiring 20% return, regardless of how much equity is put into this business and how risky it is. They just say, no, we need 20%. Debt providers require initially a low level return. They're saying we're quite happy to take 5% return because they can secure their assets, their debt on the assets of the company. And provided that debt remains within acceptable limits, in reality it's actually 70% of let's say the property values, then the cost of equity doesn't really change as we add in leverage. So the cost of equity doesn't change as we add in leverage, and this debt position has stayed the same as well as we add in this leverage. And so what we can do is we can reduce the weighted average cost of capital by adding debt to the company. So let's sort of see this in a second. Problem is though, is eventually we get to a point where we put in so much debt, too much debt in there, that we get this thing, bankruptcy risk. And at that point, the bankers say, no, we're not interested anymore. If you want us to have more debt, if you want more debt from us, actually we want a higher return than the amount that's been given to equity, because that's not our business. And at that point, adding more debt increases the weighted average cost of capital. So that's the theory. Let's just see what it looks like in a graph. So here we start with 100% equity, and the shareholders requiring a higher return. We add in our debt, our lower price debt. We replace equity with lower price debt. So we're replacing our high cost equity with low cost debt, and that averages down the weighted average cost of capital. We average it down until we get to this point here. And at this point, the bankers say, no, if you're wanting more debt from us in here, we actually want a return for that additional debt that's 25%. Let's say if this starts off at 20%, so you want 25% in there. And so as a result, and then we start to add even more and more, and they're going crazy, we're not interested in having any more. And they're well, okay, well, it'll have to be 50% return and whatever. And so this debt starts to average up the weighted average cost of capital. So in the traditional theory, there is a low point of the weighted average cost of capital where the value of the company is maximized. And the key objective for the finance director is to find that point. Okay, so what happens then? What's the competing theory? Well, Modigliani and Miller are two economists in the 1950s, and they consider the traditional theory of the weighted average cost of capital. And they say it's naive, they don't agree with it. And what they say as economists is that if we assume perfectly efficient markets, so we assume perfectly efficient markets, this is the most important bit about Modigliani and Miller, they conclude that there's no difference in the value of a company regardless of its capital structure. As more debt, notice you add in more debt, what happens is that the return required for the existing debt goes up, and also the return required for the existing equity goes up. So as you increase the amount of leverage going into the company, all that's happening is the debt's going up, the cost of the existing debt's going up, the cost of the existing equity goes up, and there's no overall change to the cash flows of the company, and therefore there's no overall change to the value. This sort of increase of debt and increase of equity returns offset the benefit of this reduced debt being added in. They liken the cash flows of a company to like a vat of milk. All you've done really by adding in debt is you've creamed off this nice part which you secured against some assets really and provided that at this low value. But of course you've now got this sort of skimmed version of amount of milk that you're providing to the shareholders, and they're saying, hang on a second here, we previously had some milk, now we've got some semi-skimmed milk, we want a higher return for that. And so overall, it's important, assuming perfectly efficient markets, the weighted average cost of capital is the same regardless of capital structure. So let's have a look at our weighted. So that is a Modigliani and Miller theory number one, weighted average cost of capital. It doesn't change regardless of the structure between debt and equity. Modigliani and Miller theory number two, they now go and consider the effect of taxation. So they sort of say, well, actually, with taxation in place, a company could deduct the interest cost of that tax, of that debt from its corporation tax. So we get a taxation benefit by having debt. Our corporation tax is lower. And in this world, the weighted average cost of capital is continually reduces up to 100% debt, where that's where the maximum taxation saving is made. And so in the Modigliani theory number two, the actual lowest WACC is where there's 100% leverage. They then go on and they add in personal debt and that kind of thing. They sort of play around with it, and they're desperately trying to find why is it that there's a low point in the weighted average cost of capital that they theoretically want to prove that doesn't actually happen. So why are companies not either 100% leveraged, or why is there an importance of the weighted average cost of capital? Okay. And this is the answer. In terms of what we're considering M&M, M&M are theoretically correct based upon their assumptions of perfect markets. In perfect markets, there's perfect knowledge, so there's no bankruptcy risk, and all individuals are the same and they are perfectly rational. So there's no advantage to one group or another group in their particular type of capital that they're offering. There's no difference in risk and reward profiles between one group and another. That's not real life. Once those assumptions break down, so does M&M's theory. So the answer is, M&M are theory are actually correct based upon the assumption of perfect markets. In perfect markets, we've got perfect knowledge, no bankruptcy risk, individuals are the same and rational. Once those assumptions break down, then so does M&M's theory of the weighted average cost of capital. So without a traditional theory, we've got the M&M theory. How does it really work in practice? Well, it's in practice, we don't just have debt and equity. A company has access to numerous sources of capital. So we've got equity, and within equity, we've got different types of shareholders as well. So we've got, let's take two extremes. We've got pension schemes on the one hand, who want, who have their position. They want large, typically safe companies, and we've got venture capitalists on the other hand. They want, typically smaller and smaller companies, and they're prepared to take high risks. So we've got different equity, different shareholders, and different risk reward profiles between those shareholders. We've got debt secured on assets. We've got debt not secured on assets, that's mezzanine debt. We've got rentals of properties. Instead of buying a property, we can lease it, can't we? We can rent it. That is a source of capital. We have to pay a return to the landlord for that. We can lease equipment, photocopiers, cars. We've got our own suppliers. They're providing us trade creditors. And there's an element in there which they're charging us effectively of capital. We can factor our debts. And there's a whole series of other things as well, but those are various sort of sources that we have of capital. And the key thing here in reality is that each of those sources understands their own market, and they have their own profile of required return for their required risk. So they have an advantage over certain people, over the other markets in their own particular market. As a consequence, they have a lower risk and return that they're prepared to accept in their market, but once they move outside their market, they have a higher risk and return than the other sources of capital. So let's take a landlord. A landlord knows how to evict a tenant, and they know how to provide rent to another tenant, and they know how to market a building. So whilst there's a risk to the landlord for providing a building as capital, to sort of lease a building, it's a lot lower than, let's say, the shareholders to a high risk company, let's say an internet company, who instead of sort of renting this building, the shareholders provide a lump of money, the company goes out and buys the building, and then there's a risk associated with that then going forward. So in this instance, for this high risk company, the landlord has got a much lower risk and return profile than the shareholders for that building. And so as a consequence, they provide that building to that high risk company at a lower amount. And so you can reduce the weighted average cost of capital for the high risk company by renting rather than buying a building. Flip side though, let's consider the public sector. Public sector can lend between 1% and 2%, and the landlord requires their required return, typically 8% of the building's value, regardless of who's actually in that building. That's what they want. They might knock a percentage point off because it's a public sector organisation, but they're not going to knock much off at all. So on the flip side here, a very low risk, I think, a public sector organisation or the government could lend at 1% to 2%. And they could buy the building. If they went out and leased a building, they would be leasing at 7% to 8%. So as a consequence, leasing rather than buying within the public sector increases the weighted average cost of capital. And what they should do is they should buy. They should get out of their leases. A photocopier or a lease firm, knows how to recover the photocopier, and they know how to sell a photocopier. They know how to recover a car. They know how to sell a car. So they're able to have a better risk profile than these high risk shareholders. Flip side though, they can't get access to sort of debt in the same way that a public sector organisation can have. So each of these organisations have different risks and rewards profiles. So in reality, what's available to the finance director is to build a book of various different sources of capital at the most efficient position for each. So you build it all up from the lowest sources of lowest weighted average cost of capitals to the highest, cut off at the point which you need to be at there, and that creates the lowest weighted average cost of capital. Well, let's say we weren't at that. Let's say we weren't at that situation. Let's say we've gone into a public sector organisation and they're leasing some buildings. Well, what you can do is you can obtain value and you can transfer from one source of capital to another, a high rate of return to another. Get out of the lease, buy a building, and that would give a better source of lower the weighted average cost of capital for that public sector organisation. Flip side, if we got a internet stock, we shouldn't be buying a building, we should be renting it. So we have that as our options. That does explain actually why the PFI initiatives and new schools sort of failed. It was because actually it was the swapping of low cost government debt for high cost private debt. It wasn't a great plan really. It was never going to work either. It was a slick presentation. So We've considered particular types of capital, but let's now consider shareholders. So the largest transactions for weighted average cost of capital purposes, they're the sales of shares between different types of shareholders, and one shareholder values the company more than the other. It is not most, whilst one organization might say, well, I can do better with that company. So let's say Elon Musk with Twitter, that most often it's actually the case that the other shareholder is saying, well, actually, I have a different risk reward profile than the current owners, and I value the company more based on the WACC. I have a different position of what my risk and reward profile is, and therefore I will produce a lower weighted average cost of capital. That's the vast majority of trades. And why does that happen? Well, different shareholders have different objectives re their risk of the company performance. What risk are they prepared to have? The pension fund versus the venture capitalist. The risk of liquidity. How quickly, what's the size of this company? Pension schemes want to invest in large companies that they can get out of that. A lot of trading in the shares that are available, I can get out of that company. And then also as well, then whether this company is generating cash for dividends to payments of pensioners or not. Now, why is it then that if you've got this liquidity risk, and I also said pension schemes like liquid firms, and therefore why listed companies on the London Stock Exchange should be approaching £1 billion, really, and anything less than that, and certainly if you're in like just 100 million or lower, you've got a very heavy discount to the value of the company because you've got this sort of bunch of shareholders that actually have a higher required return than if we took the company off market and sold it to somebody else. Well, put yourself in the position of a pension scheme. And what you need to achieve as a pension fund manager is you really just need to outperform everybody else. If you do amazingly well, great, you've got a few extra clients. But the big disaster that you need to avoid is you mustn't perform much worse than the market. If you perform much worse than the market, you lose your clients and also you lose your bonus. So you don't really want to be in for a large proportion of a reasonably small company. So let's say I've got a company of £100 million value, and I got £10 million of that as the pension scheme. I've got two problems going on. I've got 10% of the company. Don't really like holding 10% of the company. That's quite risky. It's either going to go really well or it's going to go really badly. And if we remember my objective, I just need to do a little bit better than the rest of the market. And I mustn't do worse than the rest of the market. So I've got a lot of the company. And also, let's say if it's going wrong, can I get out of this company? No, I've got 10%. If I want to get out of 10% of a company, I've got a really heavy discount to get out. So it's a disaster. So as a consequence, pension schemes and institutional investors heavily discount listed companies that are of low value. So quite often what we see is the sort of taking of companies off market and selling to a different shareholder that is not interested in the liquidity risk. They're more interested in the return and performance of the company. So why do we have these listed on the stock exchange or quoted, let's say on AIM, companies? Oh, by the way, just a quick thing there. If we're on the London Stock Exchange, the FTSE, we are listed, and that means that we follow the listing rules. If we are simply selling shares on any exchange, so let's say the alternative investment market, AIM, we are quoted. Now, you actually are entirely possible that you could be, unless you're in the corporate finance exams, but you're actually just in the professional exams for, let's say, accountancy or AAT, that the examiner will not know the difference between this and still call a quoted company a listed company, or a listed company a quoted company. But that's actually the real position. Listed on the London Stock Exchange, quoted on other exchanges. So why are companies listed or quoted? Well, some CEOs just like to be listed or quoted. It gives them a bit of an ego trip. And there's some family owner. I might be a family owner. I got 50% of the company, but I just want to be an owner, the owner of a listed company, the chair of a listed company. That's just that. No financial logic behind it, because all we're doing is subsidising the shareholders who put off lack of liquidity, having a whole series of sort of overview of us and a whole cost of being listed as well. But if the CEO is not sufficiently in control of the voting, of enough voting blocks that they can block a hostile takeover. So let's say instead of being able to sort of scatter together with sort of our friend, friendly shareholders, let's say family owners or whatever, we cannot put together a good 30 or 40% as a voting block. And instead, we've got a company with a nice scattering of 4 or 5% holdings amongst between 3 to 5% holdings between a nice sort of 30 shareholders. What we can do is we can launch a hostile takeover. And the way that we do that is we clip off from all of these institutional shareholders little percentage points as we're going along. We build up our shares there, and we get to 30%. At 30%, we launch a hostile takeover. That's what we're required to do. We can launch it before then, but we launch a hostile takeover at 30% holding of a listed company. Because the stock exchange like to see liquidity, they don't like to see these large blocks of shareholders. And we've achieved two things there. Firstly, what we're going to do is we're going to buy up, and we've recovered the discount factor that's going for this small company. And the second thing then is when we trigger this hostile takeover, hopefully somebody else is going to come in and buy it instead of us. And at that point, we're going to sell for a 30% premium on the shares that we bought. And that's how the main reason why we do hostile takeovers. So you've got these two things. On the one hand, you can get back the discount that's been applied to the company for their lack of liquidity, and you can also trigger a premium for somebody else taking over the company. So a CEO who's on a company who is listed or quoted, who cannot sufficiently block a takeover, is playing a very dangerous game, and they would be better off exiting anyway before jumping before they're pushed. On the other hand, some very large companies in private hands that pension schemes would be prepared to pay more money for. Again, no logic for it. So it's not the case that everybody's logical. Some people have other objectives. So in conclusion then, and summary of this whole WACC thing, because it's a very important thing for the whole of corporate finance is based upon it. The weighted average cost of capital is a discount factor applied to a company's cash flows when determining net present value. That's its importance. It can be reduced. If it can be reduced, if you can get your WACC down, the operations can stay the same, but you've increased the company's value, and that's the vast majority of weighted average of corporate finance transactions. Whilst M&M's theory is more logical and theoretically correct, that the structure of capital has no difference whatsoever on the value of a company. It's simply the same milk or pizza being shared out. Once those assumptions break down, the weighted average cost of capital theory tends towards the traditional model. However, in reality, the capital position is much more complex than just debt and equity, and the traditional model isn't actually happening. What's really happening is that each person has a different risk and reward profile for capital providers, and it depends on their required return, their risk profile, and the amount of liquidity that they need or don't need in there. And you can, as a finance director, build a book of these capital providers to have the cheapest weighted average cost of capital possible, and find that efficiency point of the weighted average cost of capital. So if you're not at that position, you find different providers of capital to get you to it. That's it. Weighted average cost of capital, traditional theory, M&M, real world, and what is corporate finance really all about? And as ever, thanks for listening. Good luck with your studies. See you on the next one. Bye-bye.